Imagine this. You saved for 5 years. You skipped vacations, drove the same beat-up car, made coffee at home every single morning. You finally have enough for a down payment. You're ready. You open Zillow, you find the house, you book the tour, and then your mortgage broker calls you and says, "Hey, just so you know, rates just moved again." That's the moment. That's the gut punch that millions of Americans are living through right now, in 2025 and into 2026. And if you're watching this video, chances are you are either trying to buy a home, you already own one, and you're nervous about what your equity is doing, or you're just sitting on the sidelines watching this entire thing unfold and wondering, is this market about to completely collapse? Well, that's exactly what we're going to answer today. No fluff, no filler, no fake optimism, just the raw data, the real trends, and what this all means for your money. Stay with me, because by the end of this video, you will understand exactly what is happening in the US housing market right now, why it's happening, and most importantly, what smart people are doing about it. Let's get into it. Part 1. Where we are right now. Let's set the stage, because before you can understand where this market is going, you need to truly understand how insane the last few years have been, and how unsustainable that was. Go back to 2020 and 2021. Rates were at historic lows. We're talking 2.5%, 2.8% on a 30-year fixed mortgage. Money was basically free. People were buying homes sight unseen. Bidding wars were going $20,000, $30,000, sometimes $50,000 over asking price. It didn't matter what it cost because the monthly payment was still somehow manageable. The Fed was pumping liquidity into the system. Remote work exploded, and suddenly everyone wanted more space, a backyard, a home office. Demand went through the roof, literally. And what happened to prices? They went parabolic. In some markets, home values went up 30, 40, even 50% in just 2 years. Phoenix, Austin, Tampa, Boise. These cities became real estate fever dreams. Everyone was a genius. Everyone was flipping houses. Everyone had a podcast about passive income through real estate. Then the Fed started hiking rates, and they didn't hike slowly. They hiked aggressively. By the time they were done, the federal funds rate had gone from near zero to over 5%, and mortgage rates followed. We went from 3% mortgages to 7%, 7.5%, even pushing 8% at certain points in late 2023. That is not a small move. That is a historic tightening of financial conditions. Now think about what that does to affordability. If you bought a $400,000 home at 3%, your monthly payment on a 30-year loan was roughly $1,686. That same $400,000 home at 7.5%, your payment is $2,797. That's over $1,000 more per month for the exact same house. The purchasing power of the American homebuyer got absolutely obliterated. And yet, this is the part that confuses everyone, prices didn't really crash. They wobbled. They dipped a little in some markets, but they didn't fall off a cliff. Why? Because of something economists call the lock-in effect. Part 2. The lock-in effect and the frozen market. Here's the problem. The majority of existing homeowners locked in their mortgages when rates were at those beautiful historic lows. We're talking tens of millions of Americans sitting on 2.5%, 3%, 3.5% mortgages. Why in the world would they sell? If you sell your house, you have to buy another one. And if you buy another one, you're getting a mortgage at today's rates, which are dramatically higher. So what do people do? They stay. They don't move. They renovate. They add a room. They just stay put. This completely froze the supply side of the market. Inventory, the number of homes available for sale, stayed historically low because nobody wanted to give up their cheap mortgage. And when supply is low, prices don't crash. Even if demand weakens, which it absolutely did, low supply acts like a floor under prices. So what you got was this bizarre situation, a housing market that was simultaneously completely unaffordable and unwilling to drop in price. Transaction volume collapsed. Fewer homes were being sold than at almost any point in modern history. Real estate agents were struggling. Mortgage brokers were struggling. The market was frozen like a lake in January, hard on the surface but full of pressure underneath. That was 2023. That was much of 2024. But now we're in 2026, and things are starting to crack. Part 3. The cracks are appearing. Let me tell you what Max has been watching very closely, because the data is starting to shift in ways that should grab your attention. First, inventory is rising. After years of historically low supply, more homes are hitting the market. In markets like Florida, Texas, and parts of the Southwest, active listings are up significantly year over year. In some Florida metros, inventory has actually returned to or exceeded pre-pandemic levels. That is a massive deal. When supply comes back, sellers lose their leverage. Why is inventory rising? A few reasons. Sellers who had to move, job relocations, divorces, deaths, financial distress, can no longer hold out. Some investors who bought during the frenzy are starting to feel the pain of higher carrying costs, property taxes, and insurance, especially in places like Florida where homeowners' insurance has gone absolutely haywire. There are landlords who bought short-term rentals during the Airbnb boom who are now watching bookings decline and operating costs rise. They're listing, they're getting out. Second, price reductions are accelerating. The share of homes with price cuts is climbing. Sellers are listing at optimistic prices and then having to come down. In markets that were the hottest during the pandemic boom, think parts of Texas, Tennessee, and the Mountain West, you're seeing home values pull back meaningfully. Not a crash yet, but a real and measurable correction. Third, days on market are increasing. Homes are sitting longer. In a hot market, a home sells in days, sometimes hours. Right now, in many markets, homes are sitting for 30, 45, 60 days. That is a power shift. Buyers suddenly have time to think, to negotiate, to ask for repairs and concessions. That hasn't happened in years. Fourth, and this one is critical, mortgage delinquencies are ticking up. Slowly, but they're moving. People who stretched to buy homes during the frenzy, who bought at peak prices with adjustable rate mortgages, or who have simply seen their overall financial situation eroded by inflation and higher costs across the board, are starting to fall behind. This is early stage. We're not at crisis levels, but the direction of the trend matters. Delinquency rates almost always rise before foreclosures rise. And foreclosures are what really pressure prices downward. Part 4. The macro forces. Crushing affordability. Let's zoom out even further because the housing market doesn't exist in a vacuum. It exists inside an economy, and that economy is sending some uncomfortable signals right now. Consumer debt is at record levels. Credit card debt in the US has crossed $1.2 trillion. Auto loan delinquencies are rising. Student loan repayments restarted. The American consumer, who drove this entire economy through the post-pandemic era on the back of savings and stimulus, is now running on fumes. People are buying groceries on credit cards. They are stretching every single dollar. In an environment like that, the idea of scraping together a $60,000 down payment, taking on a $3,000 a month mortgage payment, covering property taxes, insurance, maintenance, HOA fees, it becomes nearly impossible for the average American household. The math simply does not work for a massive portion of the population. Then you have the employment picture. The labor market held up remarkably well through the rate hiking cycle, but there are signs of softening. Layoffs in technology, finance, and media have been consistent. Job openings are declining. The excess savings that cushioned households are largely depleted for lower and middle-income families. And let's talk about inflation and the Fed. The Fed had been slowly cutting rates from those highs, but the cuts have been cautious, measured, and nowhere near enough to bring mortgage rates back to levels that would meaningfully unlock affordability. Mortgage rates are still elevated. The 30-year fixed is still sitting in ranges that make buying difficult and painful for most first-time buyers. And here's the cruel irony. Even if the Fed cuts more aggressively, it might not help as much as people hope. Because if the economy slows sharply, if unemployment rises meaningfully, or that creates a different kind of housing market problem. Not just an affordability problem, but a fundamental demand destruction problem. People who don't have jobs don't buy houses. People who are afraid of losing their jobs don't buy houses either. This is the trap the housing market is walking into. Part 5. Regional breakdown. Not all markets are equal. Now here's something Max wants to make very clear, because this is where a lot of people make the mistake of painting the housing market with one broad brush. The US housing market is not one market, it is hundreds of local markets, and they are behaving very differently right now. The Sun Belt, Florida, Texas, Arizona, Georgia, these markets are under serious pressure. They had the biggest pandemic-era price gains. They attracted enormous investor activity. They built a ton of new housing supply. And now they're dealing with the consequences. Rising inventory, softening prices, and in some cases like South Florida and Tampa, insurance costs that are making home ownership economically irrational for many buyers. In coastal California and the Northeast, places like New York, Boston, San Francisco, Los Angeles, the dynamic is different. Inventory is still relatively tight. Prices are stubbornly high. The wealthy buyers who dominate those markets are less sensitive to mortgage rate fluctuations. These markets aren't crashing, but they are deeply unaffordable, transaction volumes are low, and any meaningful economic shock could have an outsized effect. The Midwest, cities like Columbus, Indianapolis, Kansas City, Cleveland, has actually held up better than most people expected. More affordable baseline prices, stable local economies, less speculative froth. These markets are slower, more boring, and frankly, more resilient. The important takeaway? If someone tells you the housing market is crashing or the housing market is fine, they're both probably wrong and both probably right, depending on where they're looking. Part 6. What about new construction? There's another dimension to this story that doesn't get enough attention. The new home builders. Companies like D.R. Horton, Lenner, Pult Group, the big publicly traded home builders, have been absolutely dominant in this market. And here's why. These builders have mortgage arms. They can subsidize mortgage rates. They can offer you a 5.5% or a 5.75% rate through their own financing, even when the market rate is 7%. They use mortgage rate buy-downs to make deals happen. They have the financial muscle to reduce their own margins temporarily to keep sales moving. This has been a huge competitive advantage over existing home sellers, who can't offer the same incentives. It's also one reason why new home sales have held up better than existing home sales. Builders have been buying down buyers' rates and keeping the machine running. But even builders are getting cautious. Permitting for new residential construction has been declining. They're watching the data. They're slowing down. When even the builders who profit from building start pulling back, that tells you something important about where they think demand is headed. Part 7. What happens next? The 3 scenarios. All right, so where does this go from here? Max sees 3 realistic scenarios, and you need to understand all 3. Scenario 1, the soft landing. The Fed manages to cut rates enough to bring mortgage rates down into the low 6% range. Inventory normalizes. Prices flatten or dip slightly in overheated markets. Transaction volume slowly recovers. No crash, no massive correction, just a long, slow, painful adjustment. This is the scenario the bulls are hoping for. It's possible, but it requires everything to go right. Scenario 2, The regional correction. Certain markets, especially the Sun Belt markets with high inventory, high insurance costs, and elevated price-to-income ratios, experience meaningful price corrections of 10 to 20%. The overall national headline number barely moves because expensive coastal markets offset it. Most people don't feel a crash, but if you bought a house in Tampa in 2022, you feel it very personally. Scenario 3. The hard landing. The economy tips into a more serious recession. Unemployment rises significantly. Consumer credit stress escalates into widespread delinquencies. The foreclosure pipeline, which is currently just starting to build, opens up. Supply surges from distressed sales. Prices fall more broadly. This is the scenario the bears have been predicting for 2 years. It hasn't happened yet, but the conditions that would allow it to happen are gradually assembling. The honest answer is, nobody knows which scenario plays out. Anyone who tells you they know exactly what the housing market is going to do is either lying or trying to sell you something. What you can do is understand the risks, make decisions with clear eyes, and position yourself accordingly. Part 8. What should you actually do? Let's get practical. Because Max doesn't make videos just to scare you. He makes them so you can act smarter. If you are a potential buyer right now, don't let fear paralyze you, but don't let FOMO drive you either. The urgency of the last few years is gone. You have time to be patient. Buy based on your personal financial situation, not based on where rates might go. If you can afford the payment today at today's rates and you plan to stay in that home for at least 5 to 7 years, buying can still make sense. If you're stretching beyond your means hoping rates will drop and you'll refinance, that's a dangerous bet. If you are a current homeowner, your equity position matters enormously. If you bought before 2021 with a low rate, you're in a strong position. Sit tight. Don't panic. Respect the long-term track record of real estate as an asset class. But also, don't treat your home as an ATM. Don't lever up on HELOCs to speculate on other assets in a shaky economic environment. If you are an investor, be highly selective right now. The days of buying anything and watching it go up are over. Cash flow has to make sense today, not in some optimistic future scenario. Markets with rising inventory and insurance stress need a much bigger margin of safety. The opportunities will come, they always do, but you need dry powder and patience, not leverage and urgency. Here's the bottom line. The U.S. housing market is not over, but it is unambiguously in distress. Affordability is at historically bad levels. Inventory is building in key markets. Price cuts are accelerating. Mortgage delinquencies are trending higher. The macroeconomic backdrop is softening, and the lock-in effect that prevented a crash so far is slowly, gradually losing its grip. This is not 2008. The mortgage underwriting of the 2020 to 2022 era was far better than the subprime disaster that triggered the financial crisis. Most homeowners have fixed-rate loans and real equity. A systemic collapse is not the base case, but a significant correction in select markets, a prolonged freeze in transaction volume that punishes sellers, agents, and builders, a continued affordability crisis that prices out an entire generation of first-time buyers. That is not a prediction. That is already happening. The housing market is not over. But for a lot of people, the dream of the American home is getting harder to reach with every passing quarter. Stay informed, stay rational. And as always, your financial future is built on decisions you make when nobody else is paying attention. If this video gave you value, drop a like, leave a comment telling me what market you're watching, and subscribe if you're not already. We go deep on this stuff every single week. See you in the next one.